If at the start of the century you had 1 million shillings which you hid under your mattress, today that 1 million shillings would be worth about 250,000 shillings. Keeping your money in the bank is hotly advocated for. Heck, it's even protected by the Deposit Protection Fund. But given what we just said about the mattress analogy and its effects, the bank is no different. With the rise of financial inclusion, thanks to cryptocurrencies and an array of fintech apps, there has never been a more exciting time to take growing your wealth more seriously. In fact, people have flooded the stock market more recently and just come up like they know what they were doing, downloaded services like Yahoo Finance and the Bloomberg Terminal. Problem is, almost ever, no one really knows what they are doing. 99% of the investors lose money. And perhaps the bigger tragedy is that everyone thinks they fall under the other side, the 1% that don't lose money. Because we have this stupid saying, if you don't sell, you haven't lost. The problem with using services like Yahoo Finance, the Bloomberg Terminal, Swapbox, Jim Cramer and so on is that none of them really tell you what actually drives the markets up, down or sideways. Despite what legendary investors like Warren Buffett might tell you about investing styles like value investing, the world has changed and so has investing. We have this thing in society called trends. People no longer invest in what stocks seem the most valuable. People invest in the current, most popular, most talked about stocks of the day. The term we're looking for is hype.
We like the stock. We like the stock. We like the stock.
And you know something is wrong when everyone's talking about it. But let me tell you something, no matter what the headlines say, the stock market is always going to be okay. You found it here, and you will leave it here. There is a reason this gambling machine disguised behind legal terms like the Dow Jones, S&P 500, Nasdaq and so on has existed for centuries dating back to the early 1600s when the Dutch East India Company pioneered the concept of stock trading. It's not because as humans we have an unquenchable thirst for gambling, but that it has proven itself as the hedge against the eroding effects of inflation, which would have eaten away at the value of your money if you decided not to invest. And besides, 2022 looks promising. But the only sure way of a success in this field is doing these three things. Number 1, diversify. Number 2, dollar cost average. Number 3, have a long-term perspective. Kevin O'Reilly advises not to have more than 5% of your portfolio in one stock and not more than 20% of your portfolio in any one sector or industry.
Never more than 5% in any one name, never more than 20% in any one sector.
If your starting amount is too small for these allocations to make any sense, then you want to consider an index fund. Dollar cost averaging? You can't time the market. You buy and the market dips. You sell and the market spikes. Buy or sell at different price points to take advantage of the volatility. Having a long-term perspective is necessary. Otherwise, the monthly or even worse, the daily volatility will cost you your health. With your eyes glued to your phone, like that would even have an effect on the price action. Follow the above, and you will be just okay playing the game, even despite what finance YouTube may be telling you. Because the biggest risk to your investment in the stock market is nothing else other than yourself. Something to remember, the internet will always have an opinion on what you should do with your finances, or your life in general. Truth is, the stock market is not for everyone. Cryptocurrency trading is not for everyone. No one thing is meant for everyone to invest in. And while Finance YouTube like this channel try to educate and entertain you in all things finance, it's incumbent upon you to keep discovering yourself every day. Now that's financial advice.